Half an hour away from the opens at Hong Kong, Shenzhen, and Shanghai. You're watching the China Show. I'm Yvonne Man with David Ingles.
Good morning. Let's get to your top stories today. Stocks across Asia Pacific edging slightly higher, as you can see there on the screens here. S&P 500 closing above 6,300 for the first time in forever. Now, Japanese equities in the green while bond yields are on the up. Prime Minister Ishiba apologizing for his party's election setback.
Commodity prices in focus this morning as China's mega dam project in Tibet fuels bets on heightened demand for iron, steel, and cement.
And the Philippine President Ferdinand Marcos Jr. is set to meet Donald Trump at the White House as he seeks to reduce lower tariffs and reaffirm defense ties. Good morning. Welcome to the show. A glance at markets right now. We're slightly to the upside, but as you can see, when I'm just looking underneath the hood, with the exception of Japan, which is reopening today, there's really not a lot of volume still. And we'll see what happens because onshore markets, actually, speaking of volumes, it's the opposite that's been taking place recently there, where I think we're almost 3-4 weeks into July. The CSI 300 has yet to close lower more than 4 times. So it's been 3 down days. We've talked about turnover. We'll talk about that in further detail later on as well. As far as the data points, kind of quiet. We'll see what the RBA minutes suggest. Backward looking, of course, there. But it's really the export orders out of Taiwan. And that market's opening up right now, which might be more a leading indicator given where the market, TSMC is. Flip the boards, please. And as I say that, Singapore, of course, is now on 12 days of gains. Right, a quick glance at the macro board on your screens. 40-year yield in Japan is up about 3 basis points. Nothing happening in the treasury market so far. Slightly stronger dollar story, unchanged as far as precious metals are concerned. The story overnight, excuse me, in Chinese listings in the U.S., I guess a couple of names to watch going into today. New Oriental education was down 6.6%. Slight bit across some of the platform companies, but certainly I think might be indicative that the recent rally might be sort of hitting a wall today as far as that specific is concerned. Speaking of new, just new world development, I think got an upgrade from Goldman Sachs yesterday. So we'll see what happens with the stock later on. Futures are pointing slightly to the upside, and of course bond futures are continuing. Well, this was the move that we had yesterday, 0.5%. We'll see what this looks like in a couple of minutes. But yeah, suffice to say, a lot of the cross-asset plays have really become front and center on this mega dam project, everything from infrastructure and everything else, of course, in between.
Yeah, we were trying to figure out what was going on in the whole commodity side of things yesterday. With these massive gains in iron ore, we're talking about like 4-year highs now for the Singapore futures. And then it just became clear, this mega dam is really causing a lot of, market movements because of just the sheer scale and size of it, for one thing. Of course, there's the political implications as well, but really the market implications on how it can actually be boosting growth as well for China, too.
The scale of the project, right? Everything from cement, a couple of infrastructure stocks on the mainland were limit up yesterday, 10%. On the macro side, you had a melt up in yields on the back of a perhaps more spending, and that it might be able to unlock bottlenecks in growth as far as that part of the country is concerned. But yeah, so the 30-year yield actually saw 30-year bond futures actually saw one of its worst days in a couple of weeks yesterday. So we'll see what happens with that. Apart from that, Japan, of course, is reopening as well today.
Yeah, and it doesn't seem like we just came through an election.
Yeah.
Like with the market reaction.
It could be really any day. I could tell it's a BOJ day. You wouldn't be able to tell the difference.
Yeah, despite this historic sort of setback for Ishiba, he's just kind of hanging, I guess, his leadership and all that. So certainly that's still something that's weighing on the market. But I think that 40-year bond auction is still something that is hanging in minds of many bond traders as well. So maybe this is just a unsettling sort of calm that we're seeing, and we're seeing that across risk assets as well, right? This sort of rare calm that we're seeing this summer when it comes to risk assets. But I think there's a great story talking about this Trump put that seems to be put back into stocks, for example, or even some of the Trump trades as well. It's gone from kind of taco to now maybe a Trump put.
Yeah, we have a story on that talks about it's not just now a concept, right? A lot of the big funds have actually gotten in on that. In fact, we were talking about the S&P above 6,300, right? And who would have thought that we'd be hitting record after record again here on that specific trade? Although underneath the hood, I had to look at market breadth, for example. Here's a statistic for you. While we are at record highs, just 7% of S&P 500 companies are actually at 52-week highs. So in terms of, it's not just me that has bad breath.
It's okay. It's okay. They can't smell it through the TV screens. Just kidding. You don't have bad breath.
No. Anyway, someone who does have good breath. Let's bring Stephanie Leung in, of course.
Chief Investment Officer of StashAway. She joins us now. Do I keep leaning into risk assets?
Yeah, that's
the
a
second
good
half.
question. I think the rally that we've seen basically has been perhaps one of the most painful, kind of melt-up that we've seen. People aren't positioned for that, and particularly if we look at kind of underlying flows, it's been corporates buying back their stock that drove indexes back to the all-time highs. And I think if we look forward into August or into summer, that tends to be seasonally quite weak. Yeah. So August, September tends to be the weakest months of the year. And of course, given how hard risky assets have rallied, and we have a looming kind of trade deadline, which is to be seen whether it's the deadline or not, that seems to be set up for perhaps a summer pullback that would set things back a little bit. However, when we look at the underlying fundamentals, they still remain quite strong, right? There's a very, very little risk of U.S. going into a recession anytime soon. If anything, the market is still pricing in a 50 basis points of Fed cuts into year-end, which, could be very, very positive for risky assets. Of course, that depends on what Donald Trump says about Powell as well, but that potentially creates some sort of, near-term volatility. However, when we look at kind of the inflation picture and the growth picture, it still seems quite benign. So I do think that if we think about the themes that we've talked about since the beginning of the year, remember Fed is the new normal, FAT, fiscal dominance, AI, Trump, these are all playing out, and they are actually, quite positive for risky markets at least kind of in the next 12 months.
So how do I manage U.S. equity exposure, though, at this point in time is my question, given the themes that you mentioned certainly are at play and still are at play there?
Yeah, I think, we've always advocated a diversified approach to portfolios. To that end, for example, most of our portfolios actually have gold. In fact, all our portfolios have gold in the asset allocations. It acted as a very, very good diversifier during times of stress. Recently, of course, it's been consolidating, but if you kind of look at how much gold have done this year, the consolidation has actually been quite shallow, I would say, which shows that, people are still not over-allocated to the asset, right? They're still kind of buying into asset for the long term, for the story of debasement in sovereign kind of dollars, fiscal dominance. All of these actually lead to kind of much stronger gold prices over the long period. Also, of course, central banks keep buying. So that is still a very, very strong force going on. Within the U.S., I think we still prefer the technology sectors. If you look at kind of what are the leading companies that are kind of in this wave of recovery, these are sort of what we call the AI 2.0 companies, right? So AI 1.0 was basically what we've seen since 2022. These are the infrastructure companies, like the LLM, related, the kind of infrastructure cloud players, the Mac 7s. I think an important but subtle transition that we've seen is that the market's focus has gone from these pure infrastructure companies into companies that can actually make use of the infrastructure. So software companies is a very good example.
Yeah. The narrative maybe a few months ago was that, there was concerns in the market about these big tech companies spending too much on AI.
Yes.
It seems like now that narrative's gone back to the old days of if they spend more, it's actually good for these stocks. How should I be looking at big tech overall then now and these CapEx plans?
Yeah, I think if you look at big tech, they have actually underperformed the market year to date. Even though they have recovered, they have not recovered as much as the market. And a big part of that is sort of, I think, the earlier concern about spending, but also a somewhat positioning kind of, rotation, because everybody was actually so focused on these Mac 7 stocks before. However, I think as we kind of progress through the year, because AI is developing so quickly, what we realize is that the kind of the bottleneck in terms of LLM development is getting resolved. So we have new techniques like, for example, reinforcement learning. That's actually enabling LLMs to be much more unlimited in terms of the data they can train on. So it's not just what's available in the internet anymore. Like actually these LLMs can create new data sets to train on. And therefore you see, Meta kind of announcing big CapEx plans. I think you've seen like XAI also trying to catch up. All these big guys are spending. Yeah. And I think that's actually great for the ecosystem as a whole. And I think that's sort of just going to continue.
Okay. Another popular theme has been Europe. Do you think that trade's gotten slightly too crowded, overvalued? What do you think about Europe these days?
Yeah, we actually put out a piece on Europe. So when we look at kind of at the delta, of course, you have Germany doing big fiscal spending, which pertains to our first theme, right? Fiscal dominance. Yeah. So that is at the margin great for great for European growth. However, of course, Europe still faces a lot of structural challenges. For example, regulation. For example, demographics. And these are not easily changeable. So our approach to investing in Europe is just to be more targeted and more focused. We prefer, for example, Germany. We prefer Spain. We prefer the industrials. These are sectors that gives you good exposure to increased fiscal spending. And these sectors would continue to benefit for some time. And I guess valuation on a relative basis is still quite reasonable. So that's kind of what we think.
Final question, and I mean this respectfully, should I care about Japan, given what's going on? Or
it looks like the market is not taking a lot of note. But we think, we still like Japan over the long term, right? And here, when I say long term, you really have to zoom out. Because Japan, remember, comes out from deflation for 30 years. Right. And it takes time to kind of play out. And if you look at Europe, if you look at like Japanese JGB long-term rates, right, they are at 3%. And this is actually very, very meaningful. And the reason why Ishiba is losing, part of that is also because of inflation. So when inflation actually starts to come into Japan, it will change kind of the thinking in terms of wages, in terms of spending. But these takes time. They won't change overnight.
Is it still the macro hedge, though, Japan?
I guess Japanese yen is still a sort of a safe haven asset. But of course, I would argue that given the kind of the volatility that we see, gold, for example, is a better.
It's better than the yen as a hedge.
Than yen as a hedge, right? So.
Okay. Well, thank you so much, Stephanie Leung, there, Chief Investment Officer at StashAway. Right. As we were just talking about there, right? JGB, is that now a sort of yield play? On your screens, the cash market is reopening today, 0.3%. Your 10-year yield, the 30-year yield, nothing really happening today. I was going to say vulnerable, but it's market's telling us otherwise. Anyway, Ishiba says that he does plan to put all his efforts into negotiating a trade deal with the U.S. amidst concerns that what's happened recently might put that aside. Have a look.
We must protect Japan's interest in trade talks with the U.S., keeping in mind the deadline of August 1st. I have passed this message to U.S. Secretary Bessent when he recently visited. Akazawa will be visiting the U.S. from today, and I hope to show tangible results in trade talks soon.
And let's go live to Tokyo now, and our Japan politics and economics reporter Sakura Murakami is there with us. Sakura, good morning. Talk to us about these trade talks. What's the latest and how are things going?
So the top Japanese negotiator, Ryosei Akazawa, is already in D.C. right now, and he'll be looking to meet with his counterparts. That's namely Treasury Secretary Scott Bessent, also Lutnick, Greer. So that's going on. At the moment, the messaging from Japan hasn't changed hugely. They're still talking about investment over tariffs. But so far, also, Bessent has said the agreement has to be good for American citizens. So there seems to be a little bit of a gap in the messaging there. We'll see how Akazawa deals with the trade talks and what will come out of what will come out of his visit to the U.S.
And in the meantime, domestically, he is dealing with now no majority in the upper house. And, there's really a historic sort of setback there, Sakura. What does this mean in what he has to do now to really kind of drum up support? Does this mean that Ishiba is going to have to compromise on tax cuts?
Yeah, so inflation was a big topic of this issue, and this is pretty much all of the opposition parties campaigned on a sales tax cut pledge. And although the LDP, the ruling LDP, said that they didn't want to do that they wanted to secure Japan's fiscal health with a minority in both the upper and lower house, this might be a concession that Prime Minister Ishiba, if he does stay on, will have to look to make. A possibility of who or which party the LDP and Komeito could work with, that could be possibly the largest opposition party, the Constitutional Democratic Party. They have the most kind of cautious out of the tax cut pledges of the opposition parties. But at the moment, with the Liberal Democratic Party having very low support in general, it's not great for the opposition parties to work with the LDP. The optics of working with the LDP won't really reflect very well on them either. So everyone's in sort of an awkward position. Everyone is, there's a lot of uncertainty, so we'll have to see how things play out over the next weeks and months as well.
Sakura, thank you. Sakura Murakami there, our Japan politics and economics reporter, joining us out of Tokyo this morning. And coming up, Treasury Secretary Scott Bessent says the next round of U.S.-China trade talks could include a discussion on Russian and Iranian oil. We have detail of the latest trade talks next. We're also counting down the open of trade in Shanghai, Shenzhen, and Hong Kong. This is The China Show. All right, take a look at when it comes to your agenda today. We're watching this A-share market rally. So a pretty nascent one, but there are signs that Dave mentioned when it comes to turnover that maybe things are catching up to all the action that we're seeing here in Hong Kong as well. We talked about the infrastructure plays. Really has come down to that mega dam, and really kind of we're seeing a bit of a risk rally when it comes to some of the infrastructure, cement stocks alike, and of course the commodity side of things as well. Following Hyber is one thing. We have a good note coming on through from Goldman Sachs on New World. We'll get you that later. But ASM Pacific is what we're dealing with when it comes to earnings today. And Goertech, some news on the Apple supplier there on them refiling for a Hong Kong IPO.
Yep, that reapproach to the runway, as they say. Okay, let's talk about the U.S. now and trade talks and where we are as far as that sort of slow-moving story is concerned. Treasury Secretary Scott Bessent says that the next round of those talks could actually include a discussion of China's purchases of Russian and Iranian oil. Jill Deeses is with us right now to talk us through this, our news desk editor. And when are this next talks going to be is my other question there too.
Yeah, David, I think what we're kind of gearing up for here is, first of all, the way I would take Bessent's comments are essentially, they've at least at this point settled the economic trade matters in at least one sense. Obviously, we had those Geneva talks. We've had quite a bit of a pause on certainly some of the harshest, sort of U.S.-China retaliatory tariff efforts here. And so now it does feel like we're moving into perhaps a new phase of these talks. Now, I think at this point, we've obviously seen several steps that the U.S. and China have taken to kind of cool off tensions a bit. Most recently, the NVIDIA chips approval to have NVIDIA, continue to import, some of its chips back into China. So there's some sort of a lessening of tensions there. I would really look to what Secretary of State Marco Rubio said just a couple of weeks ago, is that there is strong desire on both sides for a Trump-Xi meeting. That's what came out of his meeting with the Chinese Foreign Minister Wang Yi. If you're looking in terms of timing, a good opportunity would potentially be the APEC summit in Seoul later this year. So that's rounding out around, the end of October there. So I think, again, at this point, you are seeing a little bit of a cooling off of tensions. Obviously, these latest comments from Bessent maybe raise the specter that national security could once again enter the conversation when these two sides do have more high-level talks. But yes, I'd say at least at this point in time, and of course anything can change, but at least at this point in time, it does seem like we're slowly kind of paving the road for that eventual meeting between Donald Trump and Xi Jinping.
Yeah, anything can change. We're seeing that in how these EU and U.S. U.S. trade talks are evolving as well. First, they were thinking maybe 10%, and now we're talking about preparing for the worst for the bloc.
Yes, that's right, Yvonne. I mean, I think, really the tune there changed after Donald Trump sent that 30% tariff letter to the EU. I think that was, quite unwelcome when, these two sides had been negotiating, and there was at least, some kind of a belief that perhaps they'd secure a baseline 10% tariff with maybe some exemptions. Now it does appear that as Trump and the Trump administration have really hardened their stance ahead of this August 1st deadline, maybe there's less scope for some of the exemptions that the EU has been looking for. I think they're still targeting potentially some on aviation, maybe some medical supplies, but again, really difficult to tell there. I think if you're the EU at this point in time, I mean, we've got 2 weeks before this August 1 deadline. Really difficult to try to imagine how they're going to be negotiating something, although obviously they are pushing pretty strongly for additional negotiations. But I think at this point in time, the EU is really thinking about what kinds of retaliatory measures they could potentially implement here. So we'll see how that ends up going over the next couple of weeks.
Jill, thank you so much. Jill Deese is there, our news desk editor. The approach to the open today just 7 minutes away, and we are looking at 25,000 now, so we're north of that level. On the Hang Seng Index, another day of gains is priced in the onshore markets, and the other thing that's taking place is iron ore is up a further $6 to $9, depending on which contract you're looking at here, now on the longest winning streak for iron ore going back 2 years. We'll unpack all those market themes for you in a moment. A preview of the trading day ahead. This is the China Show. Good morning. Welcome back. Just a preview of really a theme that's emerged because of this mega project that was, of course, the big news over the weekend here. Yeah, so everything from cement, iron ore, metal, infrastructure plays, which were, as you can see, 1.5% yesterday. So we'll track what happens here very closely. Bond futures as well. We talked about this melt up in yields, and 0.5% actually takes you back a couple of weeks to see a move of this magnitude. Dalian iron ore is already trading, and as you can see, we're now north of 810. That's one theme. The other theme related to this, of course, is this reemergence of the onshore markets with the CSI 300 back to the highest level here since the week, I believe, of the U.S. elections last year. Turnover has picked up in July to about just under 1.5 trillion daily. That's renminbi. So that monthly average almost takes you back to right after the DeepSeek moment early this year. So let's see what happens going into the open today. Yvonne.
Yep, in terms of your analyst actions, an interesting note from Goldman when it comes to New World. So it's not just New World, but maybe Hong Kong. They're called that the property market here is showing early signs of stabilization. So they're upgrading New World to neutral here on the back of also that improved liquidity situation after that refinancing deal. So there you go. Price target at 550. Sinoline also cut to a sell at Goldman though, but Bank of China Hong Kong also cut to neutral at JP Morgan. There you go. We got the pre-market looking okay. Futures are pretty flat this morning, but yes, plenty more to come. This is Bloomberg.
Good morning. Welcome to the show. And your news today is no news. It's very quiet out there. Although market-wise, we're getting some price moves to talk about today, despite the lack of, or maybe because of, who knows really, the lack of news out there. We're still seeing equity markets complacent, and the path of least resistance seems to be anti-gravity to the upside. S&P record highs, and what's taking place in Greater China, Yvonne, is also an up arrow story, broadly speaking, across both sides, China and here in Hong Kong.
You shouldn't have said it, though. No news? You think it just jinxed it.
Okay.
You're waking up the news gods,
Time to take a day off, then.
We'll see. Yeah, we need a breather, right, from time to time. You take a look at when it comes to, you mentioned all those things, right? Certainly there's still some positives going on in this China equity rally. Hong Kong was certainly the big theme and the outperformance there. And Dave mentioned, right, don't forget about the onshore market. We're slowly starting to see the CSI 300, for example, churn a little bit to the upside there, right? We talk about the turnover. I think he's talked about that $1.5 trillion on average this month in turnover onshore. And the CSI 300 basically has only closed down lower by about 3 days out of this month, right? So don't discount it for now, certainly. We're flat when it comes to the onshore market, though, here so far. A lot of the action, right? We talk about this dam is what we're seeing and when it comes to commodities, right? We're seeing in the Singapore futures, but in Dalian as well. Continue to see iron ore up to 1%. And we're very much close to some big superlatives, right? I think the Singapore contracts are at 4-month highs, the first monthly gain since January. And the Dalian futures are actually on course for the longest winning streak we've seen in 2 years, right? So, yes, it's about the mega dam, but you ask a lot of the traders out there, and what's really behind these very big surges in prices is also this whole attempt from Beijing to rein in over capacity. And perhaps that's the kind of reason why we are seeing more of this movement, because it's going to be good for overall steel prices and overall industry profitability, according to some analysts out there as well. Hong Kong is doing this right now, not a whole lot of movement. In fact, you're seeing HS Tech slightly on offer here today. Hang Seng is slightly to the upside, but as Dave mentioned, we breached above that 25,000 psychological level, which is quite telling as well on how things are going. And tech is kind of all over the place here today, right? So Tencent, Alibaba, Meituan are lower. Baidu is higher here as well. We're watching the Hang Seng property gauge as well. That's up some 0.9%. Goldman coming out with an interesting line saying early signs of stabilization in the Hong Kong property market. Mention about rental, all that like here. New World is how they're upgrading it so far, just given that refinancing deal. In terms of stocks to watch, we're talking a little bit more about the housing sector, some of these property managers. If we go back to that, there were some lines there from Xinhua talking about the need to kind of help out this industry and the like here. And we're also watching infrastructure plays, right? So yesterday it was cement, iron ore, the miners. You talk about steel. I mean, you're seeing it cross asset right now, the impact of this dam. And really, we got to talk more about what this really means, right? And overall, China's clean energy goals and the like. But there's also a lot of controversy around the scale of it and the location as well, Dave.
Yeah, because it's a dam, so it's literally at the intersection of sort of key mega rivers. It's also, which happens to also be near areas of actual borders as well. And this just gives you a snapshot, a close-up of where it is, relatively speaking, of course, in the region there. And of course, the big news on the weekend, China did launch this construction of this massive project, of course, in Xizang, that is Tibet, 3 times the size of the previous mega project, of course, which was, I think, a couple of decades back there. Here's the thing. Economically, it is expected to provide a boost, provide, of course, an energy mix there as well, unlock areas of growth there, perhaps even siphon in a lot of materials, cement, steel. It does carry some risks, though, and I think we're just at the very beginning, early innings of this as well. Things like damage to biodiversity. India, of course, intentions there as well, given, of course, where it is literally speaking. That's because certainly when you look at the river that does run through the state in northeast India is, of course, a key there. It concerns over the impact on water flows, for example. Now, in terms of the actual cost, and this might also go into what we're seeing as far as price action in the CGB space, right? So the futures were down 0.5% yesterday. Yields have been pushing higher. There you go, nearly $170 billion. And it could take at least a decade. So literally we'll be talking about this story for a couple of years to complete. But yeah, suffice to say, this is certainly something with a lot of implications. Yvonne.
Yeah, let's get to someone that's been really tracking all this and really behind this whole massive project as well, and bring in Dan Murtaugh to tell us a bit more about this, right? First of all, maybe tell us a bit more about the scale of this, the economic benefits that it has for China, before we kind of get to maybe some of the other risks out there.
That there's still a lot of details we don't know about the project. They mentioned that it's going to be basically a cascade of 5 separate hydropower projects. They have not told us what the actual capacity that they're intending to build is, but state engineers with Power China have previously said that this stretch of the Yarlung-Sangbo River could house 70 gigawatts of power. That's 3 times bigger than the Three Gorges Dam, which is currently the biggest power plant in the world. It's more than all the power plants in Poland combined. behind. So, we're looking at potentially an absolutely, massive project. But, it's also going to be incredibly challenging. It's a very remote area. This is one of the last parts of China, one of the last counties of China that was even connected by highway. So just getting the kinds of equipment, hydropower turbines, workers, like getting those people there is going to be a challenge in and of itself. And so, when you look at the price tag and you look at the time that they're looking at building the stuff, you can sort of start to see, some of the challenges that they're going to be facing and will need to overcome.
Yeah, Dan, do we know enough to have at least early estimates of how this might boost, well, number one, economic growth, and what this might also do as it pertains to the energy mix as far as the upside there is concerned specifically?
Yeah. I mean, I think that we can sort of take some good educated guesses at this. The one thing we do know is they put a price tag on it, and it's big enough, as you mentioned, David, that we're looking at something that is going to affect the macro picture in China. We've seen bond yields, we've seen stocks, we've seen commodity prices all move on it. This is Tibet is one of the poorer regions of China, so there's going to be some economic stimulus there. There's concerns from a biodiversity standpoint because this is an area where you have like cool, dry Himalayan air meeting warm, wet, moist air from the Indian Ocean, and so it's a really, really unique spot from a biodiversity standpoint. So we're hopeful that all these workers they bring don't trample it there. But in terms of the energy standpoint, it's a super interesting project. It's just in terms of how much money it's going to cost and how big it is, it's probably a lot more expensive than just building out wind and solar. But what we've seen here is, as China's had this huge energy transition, is that wind and solar have done a good job of reducing the amount of coal that needs to be burned, but it's not really yet replacing coal, because you still need, when the sun goes down, when the wind stops blowing, you need coal power plants as sort of backups to them. What this project is, if they're able to build it and they're able to succeed, this project is a coal killer. This can replace coal plants. They'll be able to shut down 50, 60, 70 coal power plants with the amount of power this generates. And so that's the kind of upside that they're looking for. But again, it's several years off, and it's going to be a really challenging project to bring in on time and on budget. So we have a long way to go before we see if they're able to realize that dream.
Yeah, so a coal killer, as you say, potentially, but it's also been quite controversial, right? What environmentalists have said. It's also led to a lot of concerns in India. Can you tell us a bit more about maybe some of the political implications around this, too?
Yeah, the Leung River, it's one of these rivers that has headwaters up in the Himalayas that feeds, winds and goes through, after it leaves China and goes into India, into Bangladesh, becomes the Brahmaputra. There's lots of downriver, uses, both for agriculture, for irrigation, and, India also wants to use this river for power, for hydropower. And so, because of the lack of details about the project, there's a lot of questions on the Indian side of, will China be able to use this to sort of, as an upper riparian controlling the lower riparian, and will they be able to reduce the flow of the river into India? Is this a potential sort of geopolitical tool? China has so far, denied that that's the plan, and they say there will be no impact on downstream areas. But without any more details, it's tough to tell, and it's going to be very difficult for India to feel assuaged that its neighbor, who it doesn't always have the friendliest relationships with, is going to treat it kindly once this project's around.
All right, Dan, thank you so much. Dan Mernsaw there in Beijing for us. Right, I guess that's a perfect segue to go into then the other parts of the energy mix, but certainly the equity market implication there is really thinning margins, or what margins in some cases. The solar industry certainly now, shares have rallied, as you can see, let's call it 11.5% going into today since the end of May. Now, Beijing has been working to really cut excess capacity in the sector, boosting bets that the profits will recover. Let's bring in Abhishek Vishnoi, our senior Asia equities reporter in Singapore, to talk us through the latest iteration of trying to stifle the price competition in many sectors here. Abhishek, will this work? What are they doing, and what are we seeing as far as markets go?
Yeah, I mean, it will work, and it's like any other sector. Anti-involution has become a sort of a movement and a buzzing word, like our team has reported in the past. And it's across the sectors. I mean, solar is just one of those sectors which is leading it right now. But we have also seen, similar measures and similar movements and measures from government side and even from company side, as far as AI is concerned, new age industries like EVs are concerned. So it's happening across industry. I mean, China is surrounded by deflationary forces, right? So it has to come out of that, and these steps are naturally, going in this direction to curb excess capacity, idle capacity, and it is showing up in stock market as well. I mean, it's not just about valuations now. As you cut excess capacity, your costs go down. That shows up in your bottom line, which becomes important, EPS, and then goes to PE as well. And therefore, we are seeing one of these photovoltaic, index carrying, these stocks, which is up about 11%, I think, and set for second straight month of outperformance versus CSI. So it's showing up in different parts of equity market, and solar industry is one part where it's leading from the front.
So certainly there's the rhetoric around, curbing these sort of price wars and the like. I'm just wondering in terms of overall the earnings picture, though, right? I mean, it looks pretty bleak right now, according to one of the, some of the ones that we've seen, the profit warnings out there from Leung Green Energy, for example. If anything, it shows us this recovery is not going to be too smooth sailing.
Yeah. The earnings picture is a bit of a to be sure. Leung Green, is expected to post a semi-annual loss, but that's like one part of the story, like one graph of the entire copy, right? It's not the full story. Valuations are really cheap. These things would show up in, earnings from 1 year from now. So, and we are trading 1 year forward estimate. So in that context, yes, it's, the reported earnings would be a to be sure, but it's definitely flowing into the future earnings estimate, and that's the same thing across the sector. And it, if you put together solar and other sectors where this is happening, this is going in the direction of an economic reset, where you are sort of weeding out counterproductive supply, on one end, and that's shoring up the bottom line. And on the other hand, you have got these mega capacity creations, like the dam project that you're talking about. So that shows up in GDP and economy as quickly as a building or a road shows up. So on both ends, China is trying to address the problems which have put it into in a deflationary sort of scenario. As it comes out of it, it becomes an even interesting bet across the sectors, not just solar.
Abhishek, thank you. Abhishek Vishnoi there, our Bloomberg senior Asia equities reporter joining us from Singapore. And still ahead, we are going to be speaking with Bank J. Safra Sarasin about why they think a long-term case for Chinese stocks could become more attractive. Her EM outlook coming up next. Plenty more ahead. This is Bloomberg.
According to what we've learned, Ms. Mao Chenyue is involved in a criminal case currently being handled by Chinese law enforcement authorities and is subjected to exit restrictions in accordance with the law. Pursuant to Chinese laws, with the case still under investigation, Ms. Mao cannot leave the country for the time being and has an obligation to cooperate with the investigation.
China's foreign ministry spokesperson there speaking about a Wells Fargo banker who has been blocked from leaving the country. And this comes as the U.S. also confirms that a U.S. Patent and Trademark Office employee has been barred from leaving China. For more, let's go to our senior China politics reporter, James Mager. He joins us live from Beijing. And James, it seems like we're hearing a little bit more about these exit bans. There's been a number of U.S. residents or citizens who have been detained in China recently. Is that rising now?
mean, there's been 2 cases in the last week, so it definitely seems to be rising. But this is not a new problem. There's a number of U.S. citizens and citizens of other countries who've also been subjected to these exit bans. And part of the problem with them is that the process is very, very opaque. In the case of Mao, the Wells Fargo banker, for example, you have the foreign ministry is now saying she's somehow connected to a criminal case, which is why she's been said they told she can't leave. There's been other cases which have been reported where the family members, U.S. citizens who are family members of a Chinese person who has fled China, are also subject to an exit ban in an attempt to pressure the person who fled and is accused of criminal actions in China to come back. So holding children or wives or ex-wives as hostages in a sense, to try and force something, try and force someone to do something. And so part of the problem is that these exit bans are very, why they're imposed is very opaque. There's no real announcement about them. And then suddenly, it comes out in the press that, these people are unable to leave China and have been unable to leave China for quite some time. And then, there's a lot of concern, obviously, from other U.S. citizens and other nationalities in China, whether they might be subject to this too, if they get into a business dispute or there's some problem. I mean, the case of the other U.S. government employee who works for the Commerce Department, he's apparently been held in China for months now. He's able to travel around the country, but he's not allowed to leave. And so, obviously, this creates a lot of concern amongst other people here about whether they can be subject to the same situation. And really, as much as China says it's a country with the rule of law, it's not like you can really appeal these kinds of things and get your day in court quickly, or in some cases with a lawyer. So it's quite problematic.
Yeah, and James, how does this all, at least, well, these 2 specific cases, let's take them because it seems to be case to case as well. How do these 2 fit into the broader negotiations on trade, and should they fit into that separate or perhaps broader conversation?
I think especially the case of the Commerce Department employee who works at the U.S. Patent Office is going to raise concerns in Washington, because apparently the reason he was detained was that he used to work for the U.S. military in the U.S. and he was detained because he didn't disclose that. And then interrogators or people who've been interrogating him have been asking him questions about his military service. So that's going to be obviously a concern for the U.S. that this person who just happened to travel to China on a private visit, he's formerly Chinese citizen, now a U.S. citizen. He's being asked questions about the U.S. government or U.S. security policy, these kinds of things. The other case, if it is just a criminal case and this Wells Fargo banker is somehow involved with that, maybe that would become less. There's plenty of Chinese citizens who are in jail or who are witnesses in criminal cases in the U.S., and that doesn't become a question of international significance. So maybe that one again, that doesn't figure so prominently. But there is there has been concern for years from the U.S. government about the Chinese use of exit bans as a tool of either foreign policy or a tool of domestic policy, as I mentioned, to try and force officials who've embezzled money and then fled the country to return. And this is only going to raise those concerns about, are U.S. citizens safe in China is obviously going to be a question that the U.S. government is concerned about.
James, thank you. James Mager there in Beijing for us, our senior China politics reporter. In some other news this morning, Vietnam is bracing really for the same weather system that we have across many parts of the Asia-Pacific, including here in Hong Kong. Well, it's forecast to intensify to a strong tropical storm before making landfall at some point today. Now, in a couple of hours, if not already being felt, that the government has warned of potential flooding, including in provinces where companies including Samsung and Honhai have factories. Wipa has developed east of the Philippines last week and actually lashed Hong Kong on Sunday with gale force winds. Now, officials and cybersecurity researchers say that hackers have exploited a flaw in Microsoft SharePoint software, reaching governments, businesses, and organizations worldwide. Now, the company released a patch over the weekend, but warns more fixes are coming as attackers continue targeting SharePoint clients. Now, the vulnerabilities were first identified in May by researchers at a Berlin cybersecurity conference. Now, India's securities regulator says Jane Street can resume trading after depositing more than $560 million in alleged unlawful gains. Now, the Securities and Exchange Board says the firm must cease any manipulative practices and comply with regulations. Jane Street denies wrongdoing, calling its trades basic index arbitrage and saying it is cooperating with the investigations. Study more ahead. This is The China Show.
In some corporate news this morning, crypto betting platform Polymarket has struck a deal to return to the U.S. market just weeks after prosecutors shut down an investigation of the company. In a statement, the company says it's re-entering the U.S. by acquiring derivatives exchange QCX in a $112 million deal. Polymarket rose to prominence during the 2024 U.S. election, allowing users to bet on political outcomes. Citigroup says it's asking its incoming investment banking analysts to disclose whether they've already accepted job offers elsewhere. The bank says the move is meant to foster a fair and transparent environment as private equity firms increasingly recruit junior bankers early. Goldman Sachs and Morgan Stanley have recently introduced similar policies.
Right, the check of market-moving stories right now, or market-moving sectors. We're looking at Chinese property stocks. What's the latest news here coming through as far as this exercise to hasten the recovery in the sector? Xinhua reporting that China is pushing to incentivize, of course, more supply in rental housing. Speaking of property here in Hong Kong, the big news this morning, Link REITs, you might have heard of the stock here, announcing the retirement of its group CEO and also commencing, of course, succession process. They're 1.6% to the upside, 1.7%, 1.76 rather, okay. I'm a bit dyslexic, but yes, that's going to work for you anyway. China Rui. Okay, so the company has agreed to buy 30% interest in Kuai-Qian Financial Services. 240 million yuan is the give or take transaction price, 34 million US dollars. Plenty more ahead. This is Bloomberg.
Welcome back to the China Show. Here's a look at the CSI 300 a half hour into the session. We started off here seeing modest, tepid gains. We basically have erased some of that here. We're slightly to the downside here this morning, but we've been talking about the chance of an A-share rally or catch-up is certainly underway. You're starting to see signs of that too, Dave, really, in turnover and the like.
As of yesterday.
Yeah.
As of yesterday. So we'll see what turnover is looking like right now. But as Yvonne is pointing out, these gains are receding quicker than my hairline, which actually says a lot because the sort of stepping back from the edge is getting quite quick at this age. Let's have a look, please, at infrastructure plays before I throw Yvonne off her chair. Iron ore is up 5 straight days. Now, I need to correct myself. My ex used to say, I don't care enough. But now I'm correcting myself there as well. I care enough to correct myself. There we go. I previously said 6 days. It's actually a 5-day. I can't count, but I still can care to correct. There we go. 1.3%. The point being, there's been a rally in metals on the back of several things. Maybe the GDP numbers kick this off. And then, of course, this mega project is giving further fuel to this current fire. Cement and energy stocks. I hear you almost want to say something.
No.
Okay.
You keep going.
Okay.
I'll chime in when.
Power Construction Corp limit up for a second straight day. Again, the mega dam project is fueling this rally even further, although it's starting to peter off again, receding quicker again than something. Japanese assets. The cash markets reopened today. First reaction or non-reaction to the political news over the weekends going into this week there. So we're now trading just a touch below the 40,000 handle on the Nikkei 225 there. Slightly stronger on the Japanese, slightly stronger in the US dollar. But you put everything together with the euro-yen cross, that's a weaker yen on your screens right now by about 0.1%. Right, looking at bond markets, there we go. Do we have treasuries too? Anyway, we can talk about treasuries later. The big question that we've gotten really is, well, we have gotten a melt up in treasury yields and Japanese yields. there seem to be global buyers willing to buy the dip on treasuries. Where is that big global buyer then when it comes to JGBs? Because the BOJ has stepped back, and yeah, that void does remain. There we go. 10-year yield, 4.36%.
Yeah, let's ask that question to Masahiko Liu, Senior Fixed Income Strategist at State Street Global Advisors. He joins us from our Tokyo studios this morning. Masa, it's great to have you. Yeah, I mean, is it just kind of much to do about nothing? You know, this upper house election, it seems like the market is pretty sanguine about these results so far. Should they be?
Yeah, I think the price action is pretty, very classic sell the rumors by the fact. We have seen the price action in Japan, JGB stabilizing, equities is doing okay, and then dollar yen is actually being sold. So yen is being bought back a bit just because of the political party. LDP has done slightly better than expectation. They are narrowly missed of majority, but they have done okay. And PM Ishiba seems to be remaining to be the PM for the foreseeable future, at least for the next 1 or 2 to 3 months time.
Masa, David here. Can I ask you then what that means for the JGB market, which obviously are there other major themes at play there, including what's happening politically and fiscally? That's just a long way of wanting to figure out, is there anything that you see that actually stops this melt up in JGB yields?
I think if you take a step back, short-term wise, sure, you have the whole global trend of steepening, and that in part put some pressure in JGB yield curve, making it a bit steeper. But longer term wise, Japan doesn't have a funding problem, number one. Number two is post-2020, if you look at across the major countries, G7, Japan is the only nation that has seen improvement in their debt to GDP terms. When you look at both gross debt to GDP and net to GDP, debt to GDP basis. If you look at the net basis, Japanese debt to GDP has actually improved by 17% from 150% to 140%, just because of Japan has a lot of debt, right? A lot of assets. You have the pension funds here. You have Japan is one of the net creditor in the market globally in state, right? And if anything, Japan has been able to outgrow and inflate a bit of the debt away in the past 5 years, and we do see that that will continue if you look at the longer term. And also, if you think of Japan, 90% of the debt in Japan is being funded domestically, right? Period. And it's not a funding issue for Japan per se, versus the likes of the UK that has twin deficits, right? And in other words, Japan, the supply-demand imbalances is easily addressable, and MOF have been doing it since this year. They've done it twice, and the latest one was, I think, 2 weeks ago, that they tweaked the whole issuance composition. I think if we do see a further steepening of a curve in Japan here, MOF will step in and further tweak that issuance composition. And in terms of Japanese banks, right, they're sitting in a lot of cash, 300 trillion yen, so that's around $2+ trillion of cash sitting in BOJ current account. And the reason why they are not piling into that, buying into JGBs is because BOJ still owns a lot of the JGBs. If you look at the 10-year zone, right, BOJ still owns 70 to 80% of the JGB. They are waiting for BOJ to gradually, cut their purchases, so QT, gradual process. And then the other word is, the other way around is like they are waiting for the terminal rate to be reached in Japan before they would actually plunge into buying the JGBs. And in terms of foreign investors, I think JGB curve, right, if you look at 530s, the spreads between 5-year and 30-year is 200 basis points, is actually the steepest among all the developed market yield curve, and it's very, very attractive. I think it's a compelling opportunity, especially for those real money investors with a longer term horizon on a currency hedge basis.
That's interesting. So maybe you think this steepening can continue, and maybe there are some long-term opportunities in the JGB market. Masa, you were just in Asia for work and really talking to a lot of clients out there. I think one of the bigger themes, if we brought it out, is this whole diversification sort of strategy, away from U.S. dollar assets, for example. What was some of the response that you got from some of the clients there? Is this something that's actually gaining a lot of traction now?
Thanks, Yvonne. Yes, I was in APAC actually last week, so Greater Asia, and I've met some of the largest asset owners in the region. And there's one common theme that has been brought up is basically the diversification, but not divestment away from U.S. Treasuries. Just the reason it's very easy, right? It's because a lot of these Asian investors, they are thinking of diversifying away a bit from U.S. Treasuries, just because you have the dynamics of U.S. Treasuries not behaving as a safe haven or a fully hedged tool like the past. But the problem is, right, when we talk about this, there's no other asset class that could actually receive all the flows if they were to sell down the U.S. Treasuries. So it's more of a diversification, but not divestment flow story. And when we spoke about diversification, a lot of this asset class that came up is one, EM local currency. Number two is actually JGBs too, right? They are thinking of JGBs hedging back to their home currency, and that provide a premium versus U.S. Treasuries that basically act as a buffer, right? If you do still see further sell-off in the JGB or in the bond market as a whole. That's why we think that the steepening trend. I think we might see a slightly more steepening trend in Japan, but then more or less it's being fairly priced, I think. And for a longer-term horizon, if you have a longer-term horizon view, I think this is a very compelling or attractive opportunity to get yourself in as an entry point if you missed the boat in May when you saw a big JGB sell-off.
Okay, just to maybe follow up on U.S. Treasuries, because you guys see flows data at State Street, which is an interesting viewpoint there. So what would you say in terms of positioning and sentiment? So would you say both those factors are in favor of lower Treasury yields, at least over the medium term?
Sure. I mean, like in State Street, I sit in the investment management side. We are the fourth largest, asset manager in the world, managing $5 trillion, and we do have that custodian bank, which have around 10 to 15% of global custody flow. And if you look at both of the data of the ETFs and the custody flow on a short-term, 2 to 3 months basis, or even looking at the long-term horizon, 5-year basis, we found that all the flows is supporting that, all the investors globally are basically underweight US and have a steeper on. So this is a very consensus view, right? So if anything, we think that if we do see a catalyst that will flip that flow, that U.S. Treasuries will stop steepening and will rally from here. It might be a mild recession in U.S. or might be Scott Bessent, Treasury Secretary, being able to fix that SLR regulation for banks, or even if you see foreigners started buying in and stopping that whole diversification but divestment theme of shining away from your treasuries, we actually think that if investors were to neutralize their position, that would actually be a positive catalyst for U.S. Treasuries from here.
Masa, a final question, just to ask you about inflation. Our economists at Bloomberg Economics have put out a forecast, and they basically see global inflation on track to fall below pre-pandemic levels, which I think the reminder for that inflation scare we had 2-3 years ago just proved to be that inflation is rat poison for fixed income. Just to not mince my words there, what assumptions are you making around the inflation environment globally, and do you have enough information to make an assumption of where inflation will be in 12 months' time?
Look, I think what goes up have to come down, right? And then this is what we have seen in the past, 3 to 4 years, I would say. You have seen a big inflation spike after post-COVID, and then we are in a disinflation trend now. It's not back to this 2%, but at least it's still at 3%. So we might have a bit of noises around that just because of this whole tariff shenanigans. But again, long-term trend, inflation, of course, it wouldn't go back to the sub 2% level. But then if I think it will manage to trend around 2 to 3%, and with a treasury curve or global rates price far above that inflation longer-term trend, right? I think this is a pretty good opportunity for investors to as an entry point to sit on carry while position for the next potential capital gains from lower rates from here.
Masa, thank you so much. Masa Liu there, senior fixed income strategist at State Street Global Advisors. Right, some lines coming through here, and there's a broader story here to Malaysia asking the United States, and this really brings to mind the new normal we're operating in, rather. Malaysia has asked the U.S. to extend tax exemptions for American EVs. Now they seek, broadly speaking, get this 20% tariffs. I know if you're joining us from 2 years ago, someone seeking a 20% levy perhaps doesn't make positive sense. It does now in this sort of world. Malaysia seeking a 20% U.S. tariff, but is resisting demands as it pertains to EVs, EV ownership specifically. There we go.
Yep, and more from that here. The Prime Minister, Anwar Ibrahim, is hoping that those tariff rates are lower than the 25% that takes effect in August 1st, and really aiming something closer to what some of the regional neighbors like Indonesia, like Vietnam got out of their trade talks as well. So this is according to our sources. But yes, those talks are ongoing this morning. Still ahead of the China show, we'll talk to Bank J. Safra Sarasin joining us now on how trade uncertainty is impacting emerging markets. Also, their call about the long-term compelling reasons why we might see this China equity rally continue here, and really has a lot to do with anti-involution. This is Bloomberg. Well, Hayman Capital CIO Kyle Bass says a hard decoupling between the U.S. and Chinese economies is fast approaching. He told Bloomberg those still doing business with China and Hong Kong post-COVID will face steep consequences in the coming years.
I think remain over the last, call it 5-6 years, maybe longer. I've said that at some point in time, the hard decoupling is certainly coming. We don't share anything in common from a values perspective with the Chinese Communist Party, and that ends up interlacing itself into trade and our relationship, our bilateral relationship. So when China took over Hong Kong post-COVID without a shot fired, and call it corrupted the judiciary and decided to break the Sino-British Joint Declaration and the U.S. declaration of our relationships with Hong Kong, I don't understand why the West continues to do business with Hong Kong and or China, and I think those that continue to do so will pay a hefty price in the coming years.
Well, what about all the big U.S. companies that, of course, want to do business in China, certainly mainland China, because of the population and obviously the perception of a rising middle class and a rising wealth class? I mean, just last week, we spent countless hours on this network talking about the deal that Jensen Huang struck to be able to sell some of his NVIDIA chips over there in China.
Yeah, look, I think that the NVIDIA deal was basically a hostage exchange. The U.S. desperately needed rare earth magnets, and China desperately needs NVIDIA's H2O chips. And I think we agreed to execute a hostage transfer, i.e., give them the chips, they give us the magnets. But the interesting thing in that transaction is they're requiring us, or U.S. companies, to enter a licensing agreement with the Chinese rare earth magnet suppliers, and we have to disclose very sensitive data to them: how many units of production we have, what the cost per unit is of each car. Ford is basically having to sell its soul to get those magnets, and we're just letting those chips move freely into the Chinese Communist Party's People's Liberation Army, and they're being used to develop AI in the battlefield, AI in their weaponry, AI to develop things to point back at us. I think that was a deal with the devil that I think we'll end up regretting.
Well, I am curious, though, but from an investment standpoint, Kyle, do you find yourself looking for places to put your money that would maybe counter what you just laid out with regards to China?
Yeah, I think that, we happen to have a partnership with the U.S. Defense Department called Rochefort Management Company, where we are looking for advanced defense technology, both on the offensive side and defensive side, in the United States to help the U.S. military and U.S. Defense Department. And there are a number of managers entering into programs like that where, we spend about 2.9% of GDP on defense today, and we all know NATO is trying to catch up to 2%, just gave a 5% target. When you look historically at periods of war, whether you're talking about the Cold War, the Vietnam War, the Korean War, and or World War II, in World War II, there was one year, 1945, where we spent more than 40% of our GDP on defense. So I think you're going to see the wind in the sails of defense and defense tech for the next decade or more. You saw it in the big, beautiful bill. There's another $200 billion going into shoring up, let's say, where our holes are and where we need to advance. So I think you're going to see defense spending as a percentage of GDP move higher, and I think the money to be invested is on the front end of defense and defense tech in the United States for the next decade.
Yeah, there we go. Strong takes and opinions there from, that was, of course, Kyle Bass, out of Hayman Capital, CIO there, Hayman Capital Management, speaking with Romain there, Bostic, our colleague there in the United States. Now, subscribers can watch us, by the way. You can catch that. There's also a conversation around the Japanese currency that they touched on there with Kyle Bass. You can scroll, that's just to say, scroll back on the TV Go to catch a lot of the interviews that you might have missed here on our shows. Of course, you want to be part of the conversation. You know how to do that for a Bloomberg client. That's IB, the IB function, and of course you can reach us and do, of course, participate. Now, really on the trade front, on that conversation that they were touching on between the U.S. and China, we're getting more lines coming through on this Bloomberg story as it pertains to what Malaysia is asking the United States, and that goes into the other story that we're tracking today in ASEAN, but also on trade. Philippine President Bongbong Marcos is in the U.S., so more on those two stories in a moment. A look at markets right now, about an hour into the cash market session. Plenty more ahead. This is the China Show.
Some stories that we're tracking for you this morning. Hong Kong media reports say that JD.com has agreed to buy a 70% stake in local grocery chain Kaibo for $510 million US. The acquisition reportedly includes Kaibo's retail business and property assets. JD.com is quoted saying that all information is subject to an official announcement. Crypto betting platform Polymarket has struck a deal to return to the U.S. market just weeks after prosecutors shut down an investigation of the company. In a statement, the company says it's re-entering the U.S. by acquiring derivatives exchange QCX in a $112 million deal. Polymarket rose to prominence during the 2024 U.S. election, allowing users to bet on political outcomes. Citigroup says it's asking its incoming investment banking analysts to disclose whether they've accepted job offers elsewhere. Now, the bank says a move is meant to foster a fair and transparent environment as private equity firms increasingly recruit junior bankers early. Goldman Sachs and Morgan Stanley have recently introduced similar policies. Officials and cybersecurity researchers say that hackers have exploited a flaw in Microsoft's SharePoint software, breaching governments, businesses, and organizations worldwide. Microsoft released a patch over the weekend, but warns more fixes are coming as attackers continue targeting SharePoint clients. The vulnerabilities were first identified in May by researchers at a Berlin cybersecurity conference.
Okay, now it took a while, but we're here. Obviously, when Donald Trump came into office, we were trying to figure out what he meant for markets. Do we take the first Trump phase in White House to help understand what it meant for markets, right? Yeah. And then a couple of months in, you had this trade negotiations with Liberation Day, which really roiled markets globally. But again, we're here. We put really two stories out today, right? How Trump trades have done, yeah, and really the underlying conviction that these big global funds have really piled into this.
It's almost, they even call it a Trump put, right?
Yeah.
It's not so much the taco trade, but there's a Trump put behind some of these assets that you talk about, right? So if you look at those so-called Trump trades, right, whether it's U.S. stocks, Bitcoin, dollar, oil, treasuries, right?
Lower treasury yields.
For the most part, you've seen lower treasury yields. Oil has come down. Bitcoin's at a near record, so is the S&P, which in some ways does show that, more or less, these sort of Trump traits have materialized the way that the president or Scott Bessent have wanted, right? Dollar is the exception, right?
Yeah.
They talked about wanting a strong dollar. But if you're trying to talk about moving manufacturing back in the U.S. and tariffs and the like, a lot of economists say that does suggest weaker dollars still.
Yes, and we did get a weaker dollar. Whether that's by design or by coincidence is another thing altogether. Right, so we'll table that for now, by the way. So there's a full story that's out on the Bloomberg terminal. Here's the plug. You can check that out. Fund giants put faith in the Trump put, as Yvonne just put it just now. Right, Goldman Sachs out with a note on Hong Kong property, and let's start with that here as far as movers go. In the cash market session here, about almost an hour in, New World is a buy, I believe, here. Out of Goldman, Sinoline was the other thing they talked about too here.
Neutral for New World.
Okay,
but
there we go.
at least Goldman is saying things are looking better, right? The property market is showing early signs of stabilization in Hong Kong. So you talk about rising residential property rents, you have falling interest rates. That certainly does bode well for the likes of New World, even after getting that refinancing deal as well. Sinoline on the flip side, though, they're saying that is a sell as the group operating profit relies on net interest income. Also talk with Link Rate there, of course, succession plans and all the like there. After the announcement of the departures at the top. And watching UB Tech there, there's a share placement there. Shares are down some 5% this morning. Plenty more ahead. This is Bloomberg. .29 a.m. in Tokyo. Japanese markets heading to lunch break as well. And if you take a look at things are pretty smooth sailing, which is a little bit surprising given what we saw politically over the weekend, those upper house elections, and we're still waiting to see the fate of Ishiba-san as well. So yeah, stocks are slightly bid up here this morning. We're seeing some weakness in the yen at 147 levels, and JGB yields in the 10-year at least are down 1 basis points as well. But we're taking a look at, of course, looking ahead, that 40-year bond auction is happening later on this week as well to deal with too. Yeah, that could be our coffee that wakes us up from what's really been what has seemed like a lunch break all morning over in Japan. Similar, ditto across these markets, as you can see. So the headline would probably be MSCI Asia Pacific hovering between gains and losses, S&P futures hovering between gains and losses, Bloomberg Dollar Index hovering between gains and losses. It's a mixed picture across the Asia Pacific. There's no volumes coming through. It's difficult being a financial journalist when nothing is happening, although we can get fairly creative. Speaking of hard-hitting journalism, this Bloomberg scoop, this is interesting, right? So we're continuing to fill in the blanks on these trade negotiations across ASEAN. We talked about Vietnam. We'll talk about the Philippines in a moment. We do understand from our reporting what's taking place as far as Malaysia is concerned, that the government is seeking to lower the eventual tariffs from the U.S. to about 20%, but there are sticking points there that might be part of that deal, reluctant to meet certain demands, including foreign ownership and also EVs. That's according to our sourcing, people familiar with what is going on with those specific Yeah, you got to ask why Malaysia is so important but the AI sort of story is very much fitting, right, in Malaysia, given the fact that they do want to remain as part of the supply chain as well. So, it's interesting that they're seeking maybe a little bit more when it comes to the tariff side of things. They want to be more like Indonesia. They want to be more like Vietnam. But also when it comes to those exemptions around EVs, that's certainly something that they're trying to continue as well. So certainly that's a big thing for the Prime Minister. They're trying to draw a red line in these trade talks when it comes to the national policies as well. We'll see if they deliver on that front.
Okay, yeah. Market reaction, nada. Okay. Philippines, let's talk about that also. So Bongbong Marcos is in the United States, set to meet President Trump on Tuesday at the White House. This does follow, of course, visits to the Pentagon and also the State Department, focused on tariffs and security cooperation. For more on this, let's bring in our colleague, Ryan Chua, is with us out of Washington to talk us through this. Ryan, nice to see you, sir. It's 10:30 in the morning here in Hong Kong. So as you guys make your way into the thick of Tuesday in that side of the world, what time is Trump actually meeting Bongbong Marcos, and what are they going to talk about, Ryan?
Well, we finally got the agenda from the White House. They just announced that meeting will take place at 11 a.m. in Washington. So that's really late at night, your time. There's going to be a bilateral meeting. There's going to be a joint working lunch between the two leaders. And obviously, all of this against the backdrop of those 20% tariffs that President Trump is threatening to impose on Philippine products if no deal is reached by August 1st. President Marcos has called those duty levels very severe. And before he left for D.C., he had pledged to negotiate a trade deal, really making the case to President Trump in person to lower those tariffs. He's, of course, under pressure to do so after two of his neighbors in Southeast Asia, Vietnam and Indonesia, managed to secure trade deals that came with lower duties on their products. And then domestically, he's also under pressure to deliver an economic win after that setback in this year's midterm elections. So all of those factors coming into play. There's trade, but we're also expecting some discussions on strengthening security and defense ties, a preview of which we got in President Marcos's meetings today with top officials in Washington.
There was also this meeting with Rubio as well. It seems like Marcos, this visit is already seeing some momentum even before this meeting in the Oval Office.
That's correct. They kept Marcos busy today. He had quite a packed schedule, really meeting with top Trump administration officials. And it's notable that in both of those meetings with Defense Secretary Pete Hegseth and Secretary of State Marco Rubio, there was a reaffirming of that strong U.S.-Philippines alliance, a lot of mention of maintaining peace and stability in the Indo-Pacific. And it's worth noting that Hegseth, in his readout of that meeting with Marcos, mentioned this 1951 Mutual Defense Treaty, which the U.S., he said, is pledging to uphold. Basically, this agreement requires both sides to come to each other's defense in case of an attack. So really, there's some momentum going into Marcos's meeting with President Trump at the White House on Tuesday. But, whether that translates into a trade deal is going to be favorable for the Philippines, of course, remains to be seen. Although some Philippine officials are quite optimistic. We heard from the Philippine ambassador to the U.S. that they're still hopeful for some sort of free trade agreement down the line. The ambassador cited the fact that Marcos's mother, Imelda, is an acquaintance of President Trump, and the fact that President Trump had invited Marcos to stay at Blair House, which is this exclusive guest house for visiting heads of state that apparently not everyone gets a stay at.
Okay, so maybe that's one bit of leverage.
Some nice treatment there.
What other leverage, or what leverage do you think Marcos then has in these trade talks with the U.S., Ryan?
Well, he could certainly play up the fact that they have this security alliance that has just gotten stronger under his administration. He's really restored that security relationship that came under strain under Marcos's predecessor, Rodrigo Duterte, who favored closer ties with China. So under Marcos, we've seen an expansion of U.S. military bases in the Philippines. He's hosted thousands of American troops for military exercises. He's even allowed the deployment of this U.S. missile defense system that China apparently didn't like. So there's a lot of things going on. And just now we heard from local media, quoting the ambassador, that talks are set to begin on building this U.S. ammunition production and storage facility on northern Luzon Island. So that's certainly a big step in deepening this security relationship. There's that security aspect. But when it comes to actual trade, the Philippine trade delegation that's been negotiating with officials in Washington have actually made some pretty concrete pledges to increase purchases of U.S. farm products like soybeans and frozen meat to address this trade deficit that has widened in recent years. But then again, everything remains to be seen. Whether all of that will be enough to sway Trump is anyone's guess. We'll certainly be watching that tomorrow.
Ryan, it looks like you have a big day ahead of you as well. Ryan Chua there joining us live from D.C. Thank you. And as we talk about, right, Trump's August 1st tariff deadline is just a little over a week away, and it's been emerging economies here in Asia making the most obvious headway in their trade talks with D.C. Indonesia, as we've been talking about, has a deal. Vietnam negotiators are working on the terms of an agreement the U.S. president announced earlier this month. What does this mean for the whole EM outlook? Joining us now is Chivakul, emerging markets economist at Bank J. Safra, Sarasin. It's great to have you, Molly. What should we be looking at when it comes to these trade deals, particularly when it comes to ASEAN, right? It seems like most want to be like the Vietnam model. Is that sort of the template?
Yeah, I think we would take that as a prototype. I mean, Vietnam is the most exposed among the ASEAN countries in terms of, trade to the U.S. And you can see that they have given up, basically, in terms of the concession to the U.S. In exchange of this 20% tariffs on the reciprocal tariffs. So I think for the other countries, it might be around this ballpark as a 20%. Although I think it is also very important to also take a look at how the sectoral tariffs will actually pan out, because that is also coming, and semiconductor exemption is still very important to most of these ASEAN countries at this point. So the effective tariffs rate is actually lower than what it is at this point. But if semiconductor tariffs is ramping up, then the picture is going to be very different. For example, for Malaysia, for Thailand, I think that's going to be a very different picture.
What do you suspect trade flows will look like once we see the final details of the trade terms with ASEAN? Because we've seen a front loading, and I wonder what to expect on the other side of that.
Yes, exactly, because I think this front loading is also because of the tariff differential between China and the ASEAN countries, right? And what we have seen so far is that if we maintain the 20% versus 40-something% for China, that will be big enough for transshipment to happen. But I think the U.S. is recognizing this, and it is trying to address this within all the negotiations with ASEAN countries. So I think we will likely see a much lower exports in the second half of the year coming out of ASEAN, given that the tariffs will likely go up, the rates, as well as the fact that you have already front-loaded exports in the first half of the year.
What does it mean for inflation? I mean, it seems like tariffs right now, is it more disinflationary, with the exception of the U.S., because it seems like it's bringing demand down, it's bringing energy prices down, and it's bringing Asian currencies up against the dollar.
Yeah, exactly. Well, I think it is only inflationary for the U.S., although we haven't really seen a real impact yet, mainly because the goods prices is still a pretty small part of the whole basket. But within the ASEAN economies, we have both the direct impact where the demand is going to be lower from abroad, as well as the impact from China, where it is trying to export more of the goods to ASEAN economies. And we have seen this. We have seen Thailand seeing deflation for the last couple of months. And we have seen all the other countries also having very low inflation.
We had a guest yesterday on the fixed income side, and the thesis that they were operating on was probably the bulk of rate cuts within EM, particularly EM Asia, are still to come. I think to the point you were making, we've seen the likes of the Philippines, Malaysia, South Korea have started rate cutting cycles a few months back, and I wonder, do you think the more cuts are ahead than what we've seen so far, or are we almost done in anticipation of the coming slowdown that you've outlined for us there?
No, I think more cuts are coming. Monetary policy is basically the only game in town for ASEAN countries. Okay. Because fiscal expansion is not really in the picture. The markets have been very sensitive to any fiscal, being not very prudent or being seen as expanding too much. So, for example, Indonesia earlier in the year, when revenue fell quite substantially, you see that markets really reacted to that, and I think ASEAN countries do not want this. So I think monetary policy is still going to be the anchor for the next 6 to 12 months.
How does that translate to markets and the outperformance we've seen in EM equities, which have basically outperformed developed markets in the first half? Can I expect the same thing to continue in the second half?
Yeah, basically you have two forces. With the force on the slowdown of growth, slowdown of the economy. Of course, rates are getting lower, and that might offset some of it, but it might not be enough, because this takes time, right? The monetary policy usually takes, I don't know, 6 months or so to actually start working. So we think that this might maybe more, in the next year.
I'd like to ask you about China monetary policy, where rates have been low for some time. In fact, they've been low for more than 6 months. That is one place where you would expect inflation to have already shown up if you go by the textbook, yet it's still low prices. And the market's trying to figure out, does China remain still only a tactical trade, or is that a long-term trade I can get into right now? What to you will be the most compelling factor that would determine whether China remains a tactical trade, or is that now a longer-term structural story that investors can buy into finally?
I think it would become a longer-term structural story if they manage to actually change the way they operate in terms of the growth model. At this point, as we have seen this anti-involution drive trying to stop the price competition, I think this is basically just going to help on the margin, because in the end, the whole picture is such that the incentive structure is built in a way that you target GDP growth at the local levels. So the local officials would like more production. More productions mean excess capacity. Excess capacity leads to price competition. And I think together with lower demand at this point, you will not be able to get to the, to get this deflationary problem, to get rid of it.
How long do you think they'll take to get inflation back?
Probably we'll get back to low inflation in the next 12 months, but I cannot really see the drive that would actually push it back towards more of its target of 2-3%.
Okay, well, thank you so much. That was great.
Thank you.
Molly Chivakul there, emerging markets economist at Bank J, Safra Sarasin there on, just about everything there. Lots to consider as we move into, of course, the thick of things in the second half of this year. Right, speaking of the second half, we're almost going into the back quarter half here of our show, and we're looking at markets have quickly reversed the early gains, including the CSI 300. It's quite out there, though. Plenty more ahead, though. This is the China Show. We're looking at some of these infrastructure plays in the region, further cementing and building on these gains that we've seen of late. The third ticker on your screen's Power Construction Corp does, of course, all things in the hydro space and everything more. And it's really shown up in markets, this mega dam project, not just in equities. We've seen it in fixed income. We've seen it in commodities as well, Yvonne. Yeah,
you talk about the different asset classes where we are seeing quite a massive sort of reaction to all this, right? The launching of this hydropower, project in Tibet. Now, and it really kind of brings you back to maybe the Three Gorges Dam, but really it's 3 times the size of the Three Gorges Dam, just to go show how massive this project is. It's expected to provide an economic boost, but also does carry some risks as well, right? Potential damage to biodiversity. And as you see with the location of this dam, its proximity to India. That's because you're talking about here. This is the Yarlung-Sangpo River. It runs through the state Arunachal Pradesh in northeast India. The cost as well is also, mountainous. You take a look at that, right? You take a look at how it is. We're talking about close to $170 billion here in terms of a price tag, and could take up to 10 years to complete. Can you give the viewers a sense of the project, why is it so important? Well, because of the sheer size of it, the environmental sort of impact there, the concerns that India has, that certainly is one thing that we're seeing there. And we should focus a little bit more on maybe what this means for India, Dave. Yeah, no, absolutely. In fact, let's get a sense of that right now, because our Bloomberg government reporter, in fact, is there with us. Sudi Ranjan Sen is in Delhi for us to really help us understand the relevance of this from where you are specifically. Just give us a sense of how this conversation is evolving in your side.
Well, to begin with, there has been and there is a sense of unease in India over this project, and it's a long-standing unease. We have seen this, pop up in discussions off and on again. But now it seems, with the announcement, the formal announcement of, the groundbreaking of the project, these concerns have deepened. What the government has kind of officially given out are the following: one, this issue has been raised as recently as January with China. B, the government has also kind of told lawmakers in India that, India has been raising these concerns with China that the interests of the lower riparian states should not and cannot be put at risk. That is where it stands. There is also an entire issue of hydrological data, which is very, very important, given the fact that we have seen kind of, the sudden flash floods in the U.S. kind of, underlining the importance of hydrological data. That hydrological data is not being shared between the two countries. So that is another cause of concern. So net in sum, a lot of concern, and we have, I'm quite sure this is not the last that we have heard over this dam and conversations on damming the Leung Sangpo or the Brahmaputra by China.
Yeah, and maybe so tell us a bit more why this sort of emergency could be a source of tension between India and China.
Well, to begin with, the Brahmaputra or the Leung Sangpo, which turns and enters into India when it's called the Brahmaputra River. It is one of the main sources of water for millions and millions of people in the northeastern region of India. That is about 7 states. It's a major source of livelihood. So any drop in water in that, it's used for agriculture, it's used for fishing, and so on and so forth. So any drop in water quantity is going to lead to tensions. A significant amount, not all of the water that comes into India comes from, from the Tibetan plateau. The rest of it is collected, from the rains on the Indian side. But even then, any drop in water will, put at risk lives of millions of people in India. And not only India, it then flows down into Bangladesh, or its tributaries flow into Bangladesh. So there is going to be impact in the lower riparian states.
All right, Sudi, thank you. Sudi Ranjan Sen there, our government reporter joining us out of New Delhi there, about how this could really emerge as maybe a source of tension between India and China. Another news this morning, India's securities regulator says Jane Street can resume trading after depositing more than $560 million in alleged unlawful gains. The Securities and Exchange Board says the firm must cease any manipulative practices and comply with regulations. Jane Street denies wrongdoing, calling its trades, quote, basic index arbitrage, and saying it's cooperating with the investigation. Treasury Secretary Scott Bessent is calling for an exhaustive review of the Fed's non-monetary policy operations, including renovations to its headquarters in Washington. The Fed and Chair Jay Powell have faced weeks of criticism from the Trump administration over the building renovations and for not cutting interest rates again. Now, in a post on X, Bessent says that significant mission creep may be jeopardizing the independence of the central bank's core monetary policy mission. We got plenty more ahead. This is Bloomberg.
Right, welcome back. We're looking at Hong Kong property, well, for various reasons. One is the upgraded calls coming out of Goldman Sachs. Number two is the Link REITs and the announcement of the CEO and changes at the top, and the process of succession is underway. That's point number two. Point number three is maybe related to that real estate, to Hainan, though, specifically on the back of policy pronouncements there, and you're looking at Hainan-related stocks. Going the opposite of Nan, which is Bay, which is north. There we go. Got you again.
Your dad jokes. Yeah, so they're talking about a free trade port development in that area. So that's why you are seeing some of these sort of duty-free operators and all that are doing pretty well here today. And yeah, some analysts saying Hainan likely to have more brands and retailers with a bigger market over time. We're watching HIBOR too.
Yeah, the opposite of high, which is LOBOR. Actually fell back below 1% yesterday. We'll get an update in a couple of minutes. That's it from us. We'll see you all tomorrow. This is The China Show.